Well, good evening everybody. Welcome to the 2023 Investor Seminar Series here in Auckland from SuperLife. It's so good to have you all here. We've been really looking forward to this one because we've done a couple of these this week. We've been in Dunedin, Christchurch, and now we're here with you, but unlike anywhere else, you crowd were the first to sell out. I couldn't put any more tickets, no more seats are available. Obviously, if a couple of people haven't made it, but what a shame. They're missing all the great market insights that you're going to get tonight, so it's great to have you here. My name's Dave, I'm from the SuperLife team, and it's a pleasure to be your MC for the evening. We're going to hear from a few people today, the first of which, unfortunately, she can't be here tonight, but we've still got her with you in some way, shape or form, and that's Anna Scott, our CEO. Stu Miller, who you've seen and maybe even spoken to already, our Chief Investment Officer, he's going to head in after that and give you a keynote address for the evening. And then we're going to bring him back with our Chief Customer Officer and one of our leading customer managers to have a leaders panel. I'm going to grill them with some questions and then we'll dive into your questions. And that'll be that. Hopefully you get something great out of the evening. We had a huge milestone earlier at the start of September this year. We had a new CEO, Anna Scott, start. So our office is, just got to figure out where Com Bay is. Our office is just over there. It used to be called the Tower Building, now the NZX Centre. And we have been so happy to have Anna join us. She's led the helm brilliantly already, even though it's been such a short time. She's our new favourite person, so it gives me a huge amount of pleasure to be able to introduce her to you as our new CEO, our team leader and the leader of your future as well. She's here with video. Please welcome Anna Scott.
Hi, I'm Anna Scott and I've recently become the CEO of SmartShares, which includes SuperLife. I have been in the financial services industry for nearly 25 years now, which makes me feel quite old. That career has spanned London, New York and Auckland, investment banking, currency trading, wealth management and now funds management. During my first 2 months, I've been meeting our team, our partners and providers, and most importantly you, our investors. We've been in Dunedin and Christchurch this week and I'm sorry that I can't be with you this evening. My 12-year-old daughter is graduating from her William Pike Challenge course tonight and I wanted to be there with my husband and son to see her receive her certificate. Although I'm not there to see you in person, I wanted to thank you for your trust in us and your continued relationship as our valued clients and investors in our products, even if I'm doing that virtually. I'm excited to be joining the SuperLife community, both for where we've come from, but also where we want to go. In this last year, we have continued to increase our FUM, that's funds under management, as well as our products. We reached $10 billion of FUM. We brought on board the ASB Master Trust Scheme and their clients, which are all now our clients too. We launched 5 new ETFs, the exchange-traded funds that are listed on the New Zealand Stock Exchange. We're currently in our 2024 budgeting and planning phase, and I'm spending a lot of my time defining our strategic direction for the next 5 years. I believe that we have an important role to play in helping more people grow their investments and savings. Our core products that track the markets can be used as investment building blocks, and we want to ensure that those products and the services we wrap around them are accessible, whether you want to be online or in person, affordable, with fees that are attractive and good value for money, and flexible. Our building blocks can be put together and used by many groups in the market, direct investors such as yourselves, financial planners, wealth managers, charities, and others. Much like balance and diversification is important in any investment portfolio, this is also true in our lives. Balancing the business along with family, hence my daughter this evening, and also community. We value you and all members in the SuperLife community, as well as the wider New Zealand community, some of whom have yet to discover the great products we have. To celebrate our $10 million milestone, we planted over 100 trees with trees that count. We were out on the streets of Auckland CBD to raise funds for Cancer Society on Daffodil Day. And we celebrated the women of NZX and SmartShares as part of International Women's Day, which we had to turn into a week because there were so many people to showcase. And we helped fundraise to send a hip-hop dance crew to the world champs in America. I hope you get some useful information out of this evening. You will be good hands with our excellent team. And as we continue to shape and improve our offering and service to you, please get in touch with any feedback, as it's always great to hear direct from you, our investors.
And while she can't be here, we have someone who is here with you tonight, and he's one of New Zealand's leading investment experts. Located just over there, we have a fantastic investment team that's managing your future. And there's one person who's helm of it all, and he's going to give you some fantastic insight this evening. And I know for many of you, it's what you're all here for various reasons. So it gives me great pleasure to welcome Stu Miller.
Thank you, David, and thank you for the warm welcome. Isn't it great how we can connect between digital and analog? And it's great to have everybody here in person rather than online. So, and that's the format that we're running for the last sort of few years. This is the second year that we've done prior to that being online. So, look, great to be here, and I will be showing a number of charts. And I know that there's a really big cross section of people in the room. Some institutional level, professional investors, right down to some people that are just starting out. Maybe even just started up with KiwiSaver. So I will show some charts. If that's not your thing, don't worry. The story is still the same. So, and equally at the end, we'll also have some time for questions, and we'll also be here at the end to ask you any curly questions that you don't want to ask publicly. So, look, I want to start with this chart just because I'm really proud of it. What this shows, what we're really trying to illustrate here, I was just trying to find my red button, are the 3-year numbers and the peer group quartile. I'm not so worried about the numbers and the returns, but this shows all the funds that we manage that are multi-asset funds, so diversified funds across the risk return spectrum. And what you can see here is pretty much all of our funds, or in fact all of our funds over that 3-year mark are in the top quartile relative to peers. So this is looking at the peer universe from Morningstar Direct, a reputable provider of consulting and fund research, and so to be in that top quartile of the group over that long period of time is a really good outcome, and really just shows the strength, the capability, and the experience that we have in our investment team to be able to manage those assets for you and on your behalf. So we are good at managing diversified funds, but some of you may well want to manage your own fund yourself, and that's one of the beauties of the SuperLife platform. You can either invest into one of our diversified funds, and we provide a range of diversified funds across the risk return spectrum, from income, which is largely in bonds and cash, right up to high growth, which has equity and property. So you can choose from one of those, managed by our expert investment team, or you can use the MyMix platform on SuperLife to build your own investment strategy, or use a combination of these funds and add on whatever little bit of flavour that you want, depending on what's happening in markets, depending on your level of sophistication. I think it's really important to note that each investor in this room has a unique, investment objective, and you also have your own willingness and ability to take risk. It can come back to the investment horizon, but there's a lot of other factors that influence how much risk you're able to take, and it is always tempting to go and move towards the funds that are likely to have the highest return, but just remember that you are taking on additional risk when you do that. So one of the most important things we want to get across, make sure that you're in a fund with a risk profile that you're comfortable with. So when you go through those ups and downs, certainly the downs, you don't want to get out of that fund at the worst possible time. You want to be comfortable with that, adding to and accumulating assets over time when they are cheap, and saving for your long-term investment goals. And for most of you, that's usually retirement. And you might have some stages along the way there. When I'm thinking about building the strategic asset allocation in our funds, and actually I will just clarify something because someone pulled me up for it in Christchurch, but strategic asset allocation is really working out what asset classes those diversified funds want to be in. It's synonymous with building your own investment strategy. So if you're building your own investment strategy, or you're allowing our experts to do that, that is effectively within a diversified fund determining what asset classes you want to invest in. And strategic asset allocation is about investing for the long term. So when I'm thinking about that for the funds and really optimizing the returns in the funds, one of the things we are looking at is global growth. And this chart here is borrowed from the IMF website. And I like this one because you can actually you can't see it on the screen here, but you can dial back the dates and sort of see what regions in the world have positive or negative GDP growth. And it's really positive that you can see in New Zealand and Australia, we've got growth that's sort of between that 0 and 3% mark, closer to 0 at the moment, but it's still growing. That is a good thing from an economic perspective, but it's not a great thing in the current environment where you've got central banks raising interest rates to try and slow growth so that they can get inflation back down to levels. And what that potentially means is that interest rates may well need to stay at high levels, which are kind of quite restricted, and I'm sure many people in this room are feeling those effects. So when you are thinking about your strategic asset allocation, you're largely thinking about equities versus bonds, and we mix a portfolio which is mostly stocks, equities, use it interpretably, and cash and bonds. And so the reason why you do that is that at times, and most of the time, you tend to find that they have a different correlation. And this chart really shows that effect. So here we're looking at the blue line that's looking at stocks. So this is the S&P 500 in the US, and the green line is bond yields. And this is looking back to the start of 2022. And you can see very recently we've had quite a big run up in bond yields. So when bond yields go up, the value of your bonds go down. So on a forward-looking basis, you are going to get a higher return, but your returns, because if you invest into those bonds, you could have otherwise been invested into a high yielding. So the value of those bonds actually go down when it happens. And you've also got equities going down as well. So in the most recent environment, if you've got equities going down at the same time as you're making losses on your bonds, now that's difficult, and a lot of you have seen that in your portfolios, especially if you're in a balanced fund which has both of those asset classes, and that's why that can feel a little bit uncomfortable. And the reason why we've seen those interest rates going up so much is really because of that economic growth I just talked about before, and because central banks have really reiterated that they're not going to be cutting rates anytime soon, and they still need to see economic growth so that supply can kind of catch up with demand and inflation can come down. This is unpicking that picture around interest rates just a little bit more, and what I'm showing here is a really long run chart. This person over here is Jeremy Powell, who's the chairman of the Federal Reserve, and really what happens with interest rates is up to him. Now you can see here that if we go right back to 1988, we had inflation that was kind of high as well. It was equally as driven by oil prices back then, and central banks weren't really sort of targeting inflation quite to the same degree as they do these days. But at the time, you did see Volcker step on inflation by slowing economic growth, raising interest rates, and ever since then, as more central banks sort of target lower levels of inflation, that we've seen interest rates come down, and that's been coming down for quite some time. But more recently, you can see, so this is 2020, we started to see those interest rates going up, and that's so this is looking at bond yields, and the central bank rate, so the Fed funds rate is the short rates that the central bank controls, that's the orange line. You can see how rapidly those interest rates have gone up. So it's actually one of the most rapid tightening cycles we've seen for quite some time. And so a lot of people are asking that question, are we there yet? Will the central bank stop raising interest rates? And we're potentially getting closer to the peak in the cycle. And the reason why I say that is we've also got the 10-year bond yield, which is reflecting longer-term outlook for interest rates, closer to where the central bank rates are. So they're kind of believing, and what the market is telling you, that the market actually is starting to believe that the Federal Reserve has raised rates, and they're likely to keep that until such point they start to see inflation coming down. So they're quite convinced. So the bond market itself is actually doing some of the tightening for the Federal Reserve, and that has a little bit more of a longer lasting impact. So that kind of tells me a little bit from a contrarian perspective that maybe the central banks are either have done or are very close to have done all of the tightening that they need. And I'll come back to a couple of other reasons why that leads me to believe that. One thing that makes that kind of a little bit uncertain is our oil prices, and what I'm showing here is the oil price. So there's West Texas crude, so the WTI price. You can see there where during the Russia-Ukraine invasion, we had oil prices spike up to $120 a barrel. Now that feeds into US headline inflation, and the headline inflation, while central banks can look through that if they think it's temporary, it does tend to lead inflation expectations. So, and the reason why it leads inflation expectations is for consumers, it's very much front and center. You go to the service station to fill up your car, and those prices are a whole lot higher. So it's like, oh gosh, prices are moving up again. And then it also feeds back into food, so the transportation of food around the country and so on. When you go to the supermarket, you feel that those prices seem to be going up, and that kind of leads you to believe that inflation is going to be high and stay high. And those are the sort of expectations that the central banks kind of need to get back into check into those lower levels. The other thing that's just caused Israel-Hamas conflict, so we saw oil prices spike back up. So while we did have oil prices coming down, and that was seeing some of those inflation expectations coming down, inflation numbers were coming down, that kind of changed once we started to see those oil prices spike back up. What we do tend to find is that with these sort of conflicts, initially when it is a shock, it does have a big negative impact on oil, particularly with the Israel-Hamas situation. If that conflict was to spread out, and actually start having other countries in the Middle East become more involved, then it could be a whole lot more of a worse situation. But as long as it's relatively well contained within Israel in that area, then people sort of start to sort of understand what the impacts might be on oil prices, and potentially they can start to come down. So with a bit of luck, we don't see things escalate in that region, and oil prices sort of normalise a little bit, and that way it won't have such a negative. We won't see inflation sitting at those higher levels, which are uncomfortable for the central bank. Again, around strategic asset allocation and building your own investment strategy, I've talked last year, and I believe to this crowd, so some of you might be familiar with the investment cycle. We talked about within the investment cycle, we're sort of sitting in that phase 3. Last year we were sitting in that phase 3 area, and this year we're kind of closer to that phase 4 area. Now, the reason why I say that is, last year we had started to see interest rates going up, but they were still relatively long, particularly at the long end of the curve. So, 10-year bond yields, hadn't really sort of moved up to levels that were overly restrictive, and they weren't really levels that you would consider attractive when the risks were still to the upside, as markets kind of priced in higher rates, and the likelihood that the Fed would continue to raise interest rates, or the Reserve Bank here in New Zealand would continue to raise interest rates to slow that growth. And so that's sort of an environment that's sort of neutral for both shares and bonds, and in that environment, cash is generally king, which you can understand why with all that uncertainty that's out there. So this is showing money market funds in the US, with investments, and that's almost gone parabolic more recently with that uncertainty that's out there. But what that does also tell you, that there's a fair amount of money that's sitting out, waiting out in the wings. On one hand, we do need to see a little bit more fiscal prudence from governments around the world. They have been spending a lot, and their interest rate bill is getting, is increasing, which means that they need to increase the supply of bonds that are available, or they need to be able to issue bonds. So that's not great for yields. But if you've got some consumers, and if it's perceived that inflation is coming down, and we did see the US CPI number come out last night, which was much lower than expected. So I think the market was expecting 3.7%. It came out 3.2%. So that's quite a big positive in seeing bond yields seeing inflation coming down. And we did see investors put some of the money to work into bonds. The reason in this part of the cycle where you do want to start investing into bonds rather than cash is because interest rates have already gone up. And if we go past that point and inflation isn't a problem, you may well, and if the economy is starting to slow, you may well see central banks start to cut rates, and therefore your returns on bonds go down quite quickly. Whereas if you started investing into bonds, which have a fixed rate of return, you can continue to receive those higher levels of return for longer, for the duration of that bond. You can also invest into a bond fund through SuperLife to get that exposure. To maybe even just illustrate that point again for anyone, and also sort of starting to unpack some of the thinking that went into our strategic asset allocation that we applied into our diversified funds. If I even take a chart that goes back further showing inflation, and go right back to 1960, you can see that period there where inflation got out of control, kind of prior to that real sort of focus on inflation for central banks. That's when Volcker, as I mentioned before, stepped in and stamped on inflation quite quickly, and we saw inflation levels coming right down So this is showing core and headline inflation. And so you can see that coming right down, and then like over the last sort of 10 years, with a number of sort of crises, we've seen inflation at very low levels, and central banks have been more focused on ensuring that they don't go into a deflationary environment. And there's been a couple of times where we've actually flirted with deflation, but one thing is largely driven by sort of secular forces of deflation, globalization and the like, that has kept those inflation levels very, very low. I mean, that's a good thing because central banks have been able to control that level of inflation, and they haven't had to raise interest rates. But it's negative in the fact that people became addicted to low interest rates, and actually believed that inflation was always going to stay low and that interest rates would continue to stay low. And so they were quite surprised when we did have that inflation come through. And even central banks themselves thought that this inflation that was coming through sort of post-COVID would be transitory. And so once they felt that economies would start opening up again, taking down lockdown restrictions, that inflation would just sort of normalise, but it didn't. And they had to act, and as I showed before in that previous slide, they had to act very, very quickly and tighten interest rates, quite quickly and to restrictive levels. And we can see that is coming down. This is just a little illustration of those secular drivers of deflation that I was talking about before. Previously, this was tilted the other way, and some of these deflationary forces like technology and demographics, they were causing less in the way of inflation. Some of these things are still deflationary in some respects, and I guess arguable around whether AI can create more productivity or not. But some of those other things like policies to address, or social policies to address the divide between rich and poor, manufacturing supply chains, so less globalization and having to onshore and hold some inventories more locally, that those sort of things put higher costs through, and that ultimately leads to more inflation going forward. The other one is around sort of climate change. Net zero policies, while they are good, they can be inflationary. So those sort of secular drivers have tilted away from being disinflationary towards inflationary. And so if I think about a scenario for, if I look at the last 10 years and think of a scenario that we might have over the next 10 years, I'm calling it a normal investment scenario. Sorry, it's nothing more exciting than that. But and what I mean by normal is that the last 10 years were probably abnormal. We had that low inflation and interest rates that I illustrated before. We also had high equity and bond valuations as a result. So with low bond yields, that implies that the valuation of bonds is high, and that encouraged sort of a risk on, risk off, because there was sort of no other alternative to get a return. You had to invest into riskier assets, in particular into equities, and then every time there was a geopolitical risk or there was some sort of thought that maybe interest rates would go up or anything, you'd have investors sort of switching back and forwards between sort of cash and equities, and that was just a risk on, risk off environment that wasn't really comfortable. That's not really normal. And at the moment we're kind of going through this transition phase where central banks are responding to high inflation, and the outlook for growth remains kind of relatively uncertain. But I think once we kind of get through this uncertain phase, we actually kind of move into what I'd characterise as being a little bit more normal. Capital market returns are really just what is the expected return on cash, equities and bonds, and what sort of risks are associated with that, and they kind of look more normal because your cash rates are closer to a normal long-run level that you would expect when an economy is in an equilibrium. And the most important thing in a diversified fund, you do want to hold those bonds because they provide you that protection when equities sell off, risk aversion goes up. In the last 10 years, we've had no return or hardly any return on those bonds, and there was always risk if interest rates went up, we'd lose money. So that didn't really help. Whereas in the next sort of 10 years, we're going to get a good return on those bonds, and so you can hold a diversified portfolio. You can have that insurance in your portfolio when equities sell off, but also have a return from that protection, which is quite nice. And in this scenario, though, the only sort of I guess the fly in the ointment is, if you are going to have, when I say higher inflation, I'm talking inflation that's potentially sort of at the top end of the central bank's target range, sort of that 2 to 3% level on average, and that's sort of not necessarily what's priced into the markets. But with that, if you're likely to have that and or sort of a little bit of volatility around the outlook for inflation, then you might want to have a bit of inflation protection in your portfolio. So you can get that through, I guess, assets like global property, notwithstanding sort of near-term risks, infrastructure. So those sort of assets have stable cash flows, and they have lease terms which have resets to inflation. But more directly, like inflation-linked bonds, even gold can provide some inflation protection. So you can sort of think a little bit outside of the traditional asset classes if you want to add something to your portfolios. And just really boiling all that down, this is just a bit of a snapshot of the outputs that we have from our strategic asset allocation when we're trying to optimise for the return for a given level of risk of those diversified funds I showed earlier. What I wanted to try and illustrate with that is in a normal environment, we end up with a normal sort of level of returns, certainly a higher return in the income portfolios which have more cash and bonds and the conservative portfolios. What I'm showing this to, and it's probably, I'm just looking at the last 12 months, and as you know, you've had quite low returns out of your cash and bonds, and that is reflected in an income fund, and probably higher than expected returns from equities and property, notwithstanding the more recent downturn. But so what that means is the 10-year expected returns, so this is forward-looking, with the assumptions that we've built into those expected returns, you can expect slightly higher returns out of your income portfolio than what you maybe have over the last 12 months. These numbers are really just looking at the standard deviation of returns historically, kind of geared for and using that on a forward-looking basis. But just to give you a sense of, say in an income portfolio, a sense of the risk that you're likely to be taking in an income fund, you could probably expect over a 20-year period 2 years of negative returns, and in a high growth fund, being in equities and property, you could expect five years out of 20 that you could have negative returns. So hopefully that kind of helps with your own sort of assessment of your willingness or ability to take risk, and those of you with long investment horizons or a goal that has a long investment horizon, you can afford to take a little bit more risk. But for those of you with shorter investment horizons, you can kind of comfortably invest into lower risk funds at a decent return. So I'll leave that there, back with the slide that I started on, and we're going to go to some questions first. Thanks.
Brilliant. But before we go any further, can we have a very warm round of applause for Mr. Stu Miller?
Thank you.
So what we're going to get into now is our leaders panel. And what we're going to do now is I'm going to ask our panel here those questions that are based around what you wanted to hear about. To address the kind of the themes that came to the room, we've got a couple of extra people with us, and unfortunately Anna is not here tonight, and we can't video in for the panel, which is a real shame. But we do have our Chief Customer Officer, Donna Mason, who is just over here.
Hi,
and
everyone.
Ivy Valderrama, who's one of our leading customer experts, particularly specialising in our corporate and sponsored and workplace clients. We're very lucky to have them both here. She's just finished, actually, as our Acting Head of Operations. We've had a new Chief of Operations start this week. I don't know how you spent your weekend, but Ivy was across the road on Saturday running a scrum. So she's been massively dedicated to that role, and we're very, very pleased to have had her on board leading so aptly during that time. I know you're tired, so thank you for coming along. So I'm going to dive into these questions now. I'm going to start with you, Stu, because we've got some business questions was one of the starting themes. So it's no secret that there are lots of other providers out there advertising good returns. Maybe not everyone in the room tonight is actually with SuperLife. They could be with another provider. So why is SuperLife still a great choice?
Yeah, look, I really do have to point to that first slide I showed up there, where we're the top quartile manager of diversified funds over that 3-year period, which really shows the experience and the capability that we've got in the investment team. While we are good at managing diversified funds, if you want to be able to do that yourself, we have the tools available for you to build your own investment strategy. So that kind of makes it something quite unique, and there's not a lot of managers that make that available. So I think you're in good hands and you have flexibility to do what you like and use our wide range of building blocks to make sure that your portfolio is invested how you would like to see it with your own unique risk return needs and objectives.
Did you want to add something there, Donna?
Yeah, I'll just add on to that, and Stu's absolutely right. Returns are just important, aren't they? That's what we all invest for, is to get those returns. I think just to add on to what Stu was saying, we've got a bit of a unique space in the market where not only are we providing those good, solid returns, but we've also, as Stu just touched on, got a really broad range of investment funds that you can invest into. And the third thing that carves out our unique market space is also that we have some of the lowest fees in the market. So when you sort of bring those all together, it's a really good proposition.
So speaking of being in good hands, at the start in the video via the link that she made for us, we heard Anna talk about SuperLife's future. So how are we investing in ourselves to deliver a future that's as best as it can be for everyone here in the room tonight?
Yeah, really good question, and thanks to those of you that came and spoke to me in the foyer. I heard from a couple of you around that our website is just not where it needs to be, and I have to say I couldn't agree more. And you'll be pleased to know that we've got a big change agenda on the cards for next year when it comes to our website and our digital experience more broadly. So not just our public-facing website, but when you log into the member portal, we've got some good plans around tools and calculators and just really enriching that experience. And then the other thing that we're looking at when it comes to sort of investing in your customer experience a bit more is just how we want to go about contacting you and engaging with you on your investments that you have with us. And one of the challenges that we've got sort of in these days is around, we're all very protective of the fact that we might be trying to get scammed from somewhere. So when we read an email and it's got a link in it, or we get sent a text and it's got a link in it, we're not always just so quick to go and click on those links. So as your investment provider, that just gives us an extra layer of things to consider when we are communicating with you. How do we do that in a way where you know that it's us and you can trust us? And again, that comes back down to the website and that logged in experience. We think that that's where you would feel most comfortable and know that it is us. And if you're logged in to your portal, then yeah, we're going to put more investment into that area.
That's really important. So staying on the customer theme, that's one of the next things that came up as a main topic. So Ivan, I'm going to throw one to you here because you spend a lot of time with our workplace customers. What is currently the key message that you tell our investors?
Thanks, Dave. That's a good question. Well, last week I was actually in Nelson visiting one of our employer groups in the workplace savings scheme. And one of the most common questions that was asked was, why is my money going down? And the simple explanation to that is, well, interest rates are rising due to the spike in inflation. Stuart has mentioned too, we've got the uncertainty of the Russia and Ukraine war. And now we've got the conflict between Israel and Hamas terror attacks. But it will self-correct. It's just a matter of when. And why will it self-correct? It's because interest rates will eventually go down. And inflation will not be allowed to rise indefinitely. And so, I mean, there could be a second wave, there could be a third wave, but it will self-correct. So the message that I tell our members is just stick to your investment strategy, stick to your savings plan, and focus on long-term investing, focus on your long-term goal, because ultimately you're saving for your retirement. And by the time you reach retirement, what you want is, you've got sufficient income to live the lifestyle that you want, and you can also have a bit of capital to, let's say, repair your car or repair your fridge or even go on a holiday.
Brilliant. Well, this is actually a really good segue because you've talked about choosing the right option for you. So when it does come to choosing a fund or funds to invest in, what should people be thinking of to help them navigate the choice that they now have when it comes to picking one?
Yeah, there's a lot of different factors to consider to help you choose the right investment fund for you. And one of it is you have to know what you're saving for. What are you investing for? Are you saving for your education, to buy a house, or are you saving for your retirement? So you have to be specific with that goal. You don't have to just have one goal. You can have multiple. But what's important is you just have to be specific. And secondly is you need to know how much money you want or how much money you need for that particular goal. Is it 50,000? Is it 100,000? Or do you want 500,000 for your retirement? If you're able to determine that, then you'll be able to, choose the right investment fund for that particular goal.
Yeah, those are really good tips, Ivy, and I'll just add a couple of my own to those. So as well as knowing what you're saving for and how much you need, I would also say think more specifically around what your investment time frame looks like. Are you saving for something that's 10, 20, 30 years away? You're going to make different decisions about where you invest that money versus if you're saving for something that's 6 months or a year away. If you're saving long term, say for your retirement, it doesn't necessarily mean either that you're going to need all of that money on the day you retire. Retirement can last a long time. And just as Ivy said, it might be worthwhile thinking about how do you want to break that money up into different sort of buckets and assign a different fund to each of those. If you're investing for a longer time frame, some of our diversified funds like our growth fund and high growth fund, they're more invested in equities and you've got longer to correct for those market ups and downs. Versus if you've got a short time frame that you're investing in for, say, 1 to 2 years, then something more on the, income or conservative side of diversified funds where a lot more is invested into cash and bonds might be more suitable. We've also got a balanced fund, which is somewhere in the middle. But the point is really knowing what your time frame is and making the right fund choice for that. The second thing is, and Stu did talk about this at the start, is sometimes your personal appetite towards investment risk might not quite match that time frame. For example, you might have a really long time until you need the money, but to be able to feel comfortable and sleep at night when markets are going down especially, you might want to invest in something that is a little bit more conservative, and that's completely fine. You kind of need to make that connection between your head and your heart when markets are down, that you've already invested in a fund that doesn't make you want to go and make some rash decisions and change your mind when it's the worst possible time to do so. So there's lots to think about, but time frame and risk appetite are two really important ones.
Well, speaking of important things to think about, and either of you can answer this one, what are the 3 biggest things our customers should know right now?
For me, our customers should know that while the markets are going down, it's just temporary. It's not permanent. It's going to self-correct. And so the message here again is just, stick to your investment strategy and focus on your long-term goal.
Yeah, and I've got nothing really new to add either, unfortunately. No quick get-rich-quick tips other than, as Ivy just said, make a choice. So make a choice of which fund you're invested into. If you haven't had a look at your portfolio recently, you haven't made a choice for some time, it might be a good chance to do that and just reset where you're invested for the future. And then, yes, stick to that course and trust yourself that you've made the right decision and that even though there are these ups and downs, that it will come back. As Ivy said, markets, that's what they do. So stay the course and choose your fund, is my advice.
Yeah, I mean, look, if you're got a good, if you invest yourself into an investment strategy and you've got a long-term goal in mind, and it's still keeping you awake at night, and you're kind of feeling anxious about that, that's probably a good sign that maybe you've picked a fund that's a little bit too risky. So really just sort of have a good think about that. Or if you've been through a period where you did see some losses and that didn't feel comfortable, that is also a sign that maybe you just need to be in an investment strategy that has slightly lower risk and where you accept lower returns, but you can sleep at night. So.
No, that's good advice. Well, speaking of market, let's keep it on you here, Stu. So the US is indicating that they could see further official cash rate increases. So in light of that being an international event, what might that look like for everyone here at home?
Yeah, well, that's a good point, and I did show a lot of charts that were talking about the Federal Reserve and US inflation, US interest rates, and that's really just because US is a big economy, a big part of the global economy. New Zealand's a very small, open economy down here in the southern hemisphere, and so what happens internationally is pretty important for us, and it does have quite a big impact. So we do look to the US to see where things are going, but There are some slight nuances, and am I allowed to show another chart?
Oh, go on.
I do have a chart here in the back of the pack that might be of interest to some people. This one here, one of the unique things about New Zealand and as sort of compared to the US, and if you're thinking about what the central banks are doing, so the Federal Reserve is raising interest rates, and how long does it take for those higher interest rates to start feeding through, and hitting the consumer in the pocket and having them sort of slow down their expenditure, which is one of the key things that sort of drives inflation, especially if supply's limited. What we find is in the US, consumers have 30-year fixed mortgages, so it can take some time for people to refinance or go and find another property or something, or for their mortgages to be rolling off into those higher rates, and so it just takes longer for that, what we call monetary policy transmission, to occur. Whereas here in New Zealand, in this chart, you can see the most people are sitting at that sort of that 1 to 2 year sort of fixed rate of mortgages, and so we're already a year or so into this tightening cycle, and people have already started to feel the effects. And I think last count it was sort of getting up to around about 7% of mortgage holders had already rolled into higher interest rates, and so that monetary policy transmission is much quicker into the economy, and so our economy may well slow, or at least we won't need to do a whole lot more work than what the Reserve Bank has already done, with a bit of luck. And if inflation is contained offshore, then that won't flow down here to our market, and so with a bit of luck, we may well see interest rates come off a little bit, or at least stay stable here for a while, relative to the US, which may need to tighten interest rates more if inflation doesn't come down.
Okay, well, given the economic insight for us here, there's a range of ages and life stages in the room. It could be that you're investing for a first home. It could be that retirement's your next focus. So what, if you're investing to achieve these goals amidst that world of change in the economy that you've talked about, what does investing for growth look like in that economy?
Yeah, I mean, investing for growth in the current part of the investment cycle is kind of quite tricky. Like I showed before, it's either neutral or from phase 3 for both equities and bonds, and then phase 4 is kind of better for bonds because you can get those fixed rate returns and some decent yields on the bonds. But there are some parts of the equity market that you can get some good returns, and if you're getting specific about those parts of the market, you can sort of look towards some of those sectors that aren't overly capital intensive, so they're not as affected by higher interest rates as some other companies that don't. Things like franchises, they don't have a lot of capital intensity, and they're largely making their money off their IP. Same with some of the technology companies that are out there that are doing better. They are affected because they are growth companies, so by nature, the valuation of those companies really depends on longer term future expected cash flows, but they can be a little bit more resilient in this sort of environment. And the other one is really just growth companies or companies that are growing due to a different sort of industry dynamic, something that's not so much linked to the global economy, and you can find some companies that can do reasonably well in that sort of environment as well.
Cool. Donna,
I'll just
ahead.
add on to that, and if all of that sounds far too complicated, we've got a product called SuperLife Age Steps, which Stu's team of investment professionals have packaged together, and what it does is it makes your investment choice for you. So you invest into it, and over time it reduces the amount of risk that you're taking, so that you glide into retirement and beyond with far more in income assets, which is those cash and bonds, and less in shares and property. So that's another good option, isn't it, Stu?
Absolutely.
Well, speaking of good options, should I dive through to some questions that have come from the audience? What do you reckon?
Yeah, give it a go.
Sweet. Can I let me click it back? Thank you very much.
No more slides for me.
Oh, maybe. If you ask real nicely. I'll keep it up there so you can feel free to add to. I've just been allowed to see the screen. I'm not seeing these ahead of time. Thank you, Iris. Okay, we're going to start with some big ones. We had some good questions throughout the week at Dunedin and Christchurch, but you might have taken the top one here. Where did Dave get his socks from? Well, well, well. It's not just market insights we're looking for here, are we? No, look, this section's brought to you by Happy Socks. Thank you for asking. I've already bought my first home and I'm a wee way away from retirement. Does SuperLife have investment options outside of KiwiSaver?
The answer is no. We've got KiwiSaver, we've got our SuperLife Invest. Well, sorry, we do have investments outside of KiwiSaver. If you think of it that way.
So I might just read
I'm
that one
thinking
again.
KiwiSaver or
We
funds.
do.
Yeah, so let's back up on that one. Yeah, no. So we've got
Rewind.
KiwiSaver funds, but we also have our SuperLife Invest, which are unlocked and voluntary funds. So you can invest money into there and not be locked in like you are with KiwiSaver. I was thinking you were sort of thinking outside of funds into stocks and bonds specifically. But largely you can build your own investment strategy with the range of funds we've got, because we've got little sectors. You don't necessarily need to go and pick the individual stocks or securities. You can do that through your broker. You can invest in New Zealand bonds only if you want to, or just cash, or you can invest into US large cap growth as an example if you want to get exposure to some of those larger growth companies, some of those larger tech companies that are available offshore and specific to the US. So there are lots of options to be able to manage that.
So just to clarify, yes, we've got a scheme called SuperLife Invest, which is essentially the same as our SuperLife KiwiSaver scheme, except it's unlocked. So there's no retirement age on it. You can just invest in it and then withdraw your money as often as you please. So that's a really great option as well if you're wanting to save for a short or long-term goal, but you don't want those sort of restrictions that KiwiSaver has. And the other thing I'd point out, which just might be of interest to some people in the crowd, and something that we've been asked about as we've gone around these roadshows, is what about for kids? And we've got a great product called My Future Fund, and Ivy might chip into this part of the conversation too, where it's set up for kids. The guardians are in control of it, so you can set the age at which the child becomes responsible or can take over the ownership of the account. But it's a great way to get kids into investing, and what happens is you're investing at your child's pie tax rate. So if they're at school or they're not working or whatever it may be, then the tax on it is a lot lower than it would be on your own personal savings account. And it's a great way to work together with them to show them what different funds they can have and what their returns are and that sort of thing. Do you have anything to add on that?
No, that's right, Donna. And also for My Future Fund, most of the guardians are parents or grandparents. So you don't have to be a parent. You could be a grandparent, an uncle, an aunt, whatever. So you can invest for that child's future. Most of our guardians would invest for their education, actually. And then by the time the child reaches age 18 or 25, then they have the option to release that guardianship and then give sole responsibility of the account to the child themselves.
It's a great option for birthday presents rather than giving something you can put into that future fund. Yeah. If you wanted to learn more about SuperLife Invest, there's a lot about that at superlife.co.nz, or please get in touch with us if there's something that you feel like you missed and you want to learn a bit more. All right, next one. How long must you be with any KiwiSaver provider to be eligible for the first home grant?
Grant or first home withdrawal? First home withdrawal, you have to be in KiwiSaver for 3 years. So you have to be a member of KiwiSaver for 3 years, and then you can apply for the first home purchase.
Any insights on the grant?
On the grant, it depends on there are different eligibilities for the first home grant. So we have to look at it at different, scenarios.
Okay, cool. Did you want to add to that, Donna?
I was just going to add on. I don't know if this is useful or not. So the grant is different to your KiwiSaver first home withdrawal. So your first home withdrawal comes out of your own KiwiSaver account. It's your money and your employer's money that's been saved up and that you can access when you go to purchase your first home. And there's some criteria around that you need to meet. It needs to be your first home and I don't know, that's pretty much it. Whereas the first home grant is not related to your KiwiSaver. It's money that's provided to you by the government, but to meet the criteria for that grant, you need to be a KiwiSaver member, but the money doesn't come out of your KiwiSaver account. And some of the criteria that Ivy was just talking to, it's different criteria, so it's more around what your income is versus the area that you live in and that sort of thing. But we can help you through both of those. If you need our help, just give us a call or come and see Ivy and I at the end.
Perfect. Do you plan to issue more FX, sorry if that means something, an acronym that I'm not familiar with, FX hedged funds given the foreign exchange risks?
Yes, and we're seeing a lot of demand from advisor groups, and that's really helpful, because these are people that are giving advice directly to retail investors, like many people in this room, and they're looking at the level of the New Zealand dollar sort of being at 60 cents and sort of touching on the 58 sort of cents the other day, potentially being a bit lower, but if we were to go into that sort of environment at the moment, like I said before, probably the bias is that the New Zealand economy is a little bit weaker, and it's probably more likely that the relative interest rates are going to be in favour of the US instead of New Zealand. So there's not any real urgency right now, but advisors are looking at those levels and saying, well, if I want to start putting some hedging in place, so protect myself from an upwards move in the New Zealand dollar, I want to be able to use those hedged funds. So we currently have, as an ETF format, so we've got, within SuperLife, we've got the Overseas Shares Hedge Fund. We also have the Total World Hedge Fund, which are two options that are available. One of those is a little more focused toward developed markets. The other one's sort of more includes emerging markets and small cap. So you can choose between the hedged version and unhedged version to be able to apply currency hedging. And to answer the question more directly, which ones are we launching new ones? We've just recently launched a global government bond fund, which is fully hedged. That is in the ETF format and potentially brought to SuperLife in due course. S&P 500 hedged, we just recently launched to complement other investors that just want to have a US, sort of a quality US bias in their portfolios, to complement the US unhedged that's in their portfolios. And then we've got the infrastructure, global infrastructure and global property, both of those are hedged. So we recently launched those also in ETF format and not available in the SuperLife, through the SuperLife range at the moment, but we're looking to bring those to SuperLife, to the SuperLife platform for you to be able to invest into. But you can invest into those other ones either through your broker or go to the SmartShares website and you make contributions to them. They're essentially very, very similar funds.
And if you didn't know what hedged and unhedged means, what's the quickest definition you can give that?
So essentially with a hedged fund, we're hedging the currency exposure. So if you go and buy a US asset, you need to sell New Zealand dollars and buy US dollars to buy that US asset. And so you automatically have US dollars. And by hedging, what we do is we're using forward foreign exchange contracts. We sell US dollars and buy New Zealand dollars forward, and that effectively neutralises that currency exposure that we've got. So we just have the US equity exposure, but not the currency exposure that goes with it.
Perfect, thank you. Oh, this is a good one. Do you have financial advisors who can help us choose the way we invest? Donna, can I give this one to you?
Yes, this is Ivy. She's a financial advisor. So yes, we do. We definitely do. We've got financial advisors that work for us that are employees of SuperLife, and they can help you navigate things like what is the right investment fund for you. Down the back of the room in a green top, we've got Hillary. She's also one of our financial advisors. There she is. And we've got others that work in the office with us. So if you need help with what fund should I be invested in, these ladies can do things like ask you a few questions. They'll run through what we call a statement of advice and give you advice on the right fund for you. We also have financial advisors that we work with closely across the entire country, and those financial advisors are independent. And if you need some advice that's beyond the scope of what we can provide, or you need advice on your more holistic, saving and investing plan, then we can refer you to one of them as well.
Perfect, thank you so much. What's your forecast for the first rate cut of RBNZ? Oh, it's a spicy question.
It depends if I'm a gambling man, but look, I am sort of more of a strategist, so I kind of like to look at where the market is kind of pricing, and I think the market's starting to price in rate cuts either at the end of the first or sort of second quarter next year. I think that's probably a reasonable estimate, but we need to see some more evidence that inflation is coming into the Reserve Bank's target range. So at the moment it's still sitting up above there, and I really don't think that they want to indicate that they want to cut rates anytime soon. And like I showed before, economic growth is still there and kind of proving relatively resilient. So we'll see how that plays out. We have seen in the US the inflation numbers coming down, so maybe that might give some reprieve, but there will be a little bit of pain to come just yet.
Let's stay on the pain thing you just said, because this one's got a good segue there. The last 3 years have been pretty dire. This is a two-parter. Previous downturns have been 18 to 24 months. The first part is this a new normal?
So looking back over the last sort of 18 months or so, that's kind of what I'm calling the transition phase. So when I was talking about a normal sort of environment for the next sort of 10 years, I think that's what this question sort of referring to is, I see it more normal. So once we've been through that transition phase, which is very volatile, it's not saying that you're not going to have volatility in markets. It's not to say that you're not going to have over the 10 years a number of those investment cycles. What it really means is that we will see inflation sort of come down to levels where central banks can either hold interest rates or lower them a little bit. And while you're still getting some returns on those bonds, it sort of makes it more of a normal environment. And on average, over that period of return, over that next 10-year period, you should at least get a cash return if you invest into cash, or at a cash rate that's around those sort of longer-term sort of normal levels. And if you invest in bonds, you should get a cash plus a term premium, or in equities, cash plus an equity risk premium. A sort of longer run equity risk premium that you might have otherwise seen. It's sort of quite a crude way of coming up with an expected return, but that's kind of really, that's sort of what we've observed, historically going back over multiple years, and that's kind of a building blocks method using some well-known approaches to come up with those expected returns.
So speaking of well-known approaches, the second part of it is how do you stack up against your competitors in that environment?
In terms of building investment strategies, I think you can look at those returns and say, well, are we good at managing diversified funds? Yes. So yes, we're stacking up well relative to our competitors. Look, as far as like forming capital market assumptions, I don't really want to say that coming up with expected returns, we can do that better than anyone else. We won't know for at least 10 years. And they are really just estimates. On any given year, it's pretty likely that we will be wrong. But we need to have some sort of way to try and give an indication of what the expected returns are. And it's probably more important to think about the relativity between the return on cash and the return of equity, and then a combination of those things. So in a balanced fund, what sort of expected returns can you have on average over a long period of time? And then from out of that, we can deduce sort of what the risk might look like. So using some of those assumptions around a probability of loss over a 20-year period. So it just sort of helps investors with trying to understand the risk-return characteristics of a diversified fund that they're thinking about investing in. It's not suggesting that we can predict returns better than anyone else.
I'm about to absolutely run out of time, so I'm just going to give one more quick one, because this has been a theme that's occurred a few times. I'm 55. I'm looking at retirement. Should I invest in conservative or high growth if I'm targeting 65?
So generally, you could probably even answer the question because you've already been talking about it. But in general, and this is what the age steps model does. So we have a glide path that as you age, your investment horizon is ultimately getting shorter, and as you're nearing retirement, you want to be reducing your risk. So the thing is, as you're getting closer to retirement, and you might need to utilise those funds, you don't want to be invested into too much in the way of equity. You still can invest into equity, because remember, your investment horizon isn't up until 65. You'll probably need that cash right through to, on an average life expectancy, around 87, 88, right? So, or even yeah, anyway, around about that then. So you can think longer term, and you can think for the next generation as well. So don't get too hung up on that. But you know, the general rule of thumb is you get close to that, you want to be moving down that risk spectrum, you know, out of growth into conservative income, so that if you do have a drawdown in equity markets, you still have time to be able to recover some of those losses.
Yeah, those are really good points, Stu. Just adding on to that, I think, do you really need that money all right away? Would be another good question to have a think about. So you might need some of it right away, but you might need some of it 5 years later, 10 years later, whatever, and so on. And within the SuperLife scheme, you can change your investment portfolio that way, so you can be invested in more than one fund. So you might attribute $10,000 to a more conservative fund because you know that you're going to need that money sooner, whereas some of that money you know needs to last you a bit longer, so you might put some in a balanced fund or a growth, whatever meets your investment time frame, as well as your risk appetite. So I would challenge to think of it that way as well, that you're probably not going to need all of that money just on day one. Yes, thank you.
Unfortunately, that is the only time I can take up for many more questions. There were about probably 12 more on the slider that I could see, so we're going to stay around so that you can ask them afterwards. Please come up and have a chat. They'll love to get more time with you guys here. The last thing to do for me is to say a huge thank you to all of you for coming out tonight. Even though the office is only across the road, it's surprisingly rare how often we get to have time with our investor community. You've sacrificed your time and your evening to come tonight, and we greatly appreciate that. This is for you, so thank you very much for coming. Please come up and talk to them afterwards, but one last time, can I get one round of applause for the leadership panel?